As tariffs on foreign imports begin to take effect, there's been rumors circulating online that ports have been seeing fewer cargo vessels, and the port of Seattle is turning into a ghost town.
The tariff slowdown has begun. Bookings of container shipments from China to the U.S. are down nearly 50% compared to a year ago, according to shipment tracker Vizion.
The U.S. economy is on alert. Ships still sail the ocean, but their holds are half empty. Operators in crane cabins and assembly robots in Ohio listen to the same silence. In just 30 days, the U.S. has lost $68 billion in imports, a 20% drop in import volume due to additional tariffs. Although the shelves are full, U.S. port cranes are empty, and supply lines have ground to a halt. In 4 weeks, a fifth of all containers entering the U.S. disappeared. Crane operators at the Port of Los Angeles went shiftless, and robots waiting for screws on assembly lines in Ohio fell silent. Ports without empty cargo ships, 34,000 tons of cargo missing, a $68 billion deficit. But is this heartbreak a temporary jolt or a harbinger of an intricate rupture that could permanently shatter the global supply network? Don't forget to subscribe to our channel, turn on notifications, and give us a like to stay up to date with our content. The April trade figures for the United States show a sudden collapse in the protectionist wave that has been building up over the last few years. According to the reports, the volume of goods entering the country fell by 20% compared to the previous month. This was the sharpest monthly contraction since the statistical series began. Official Commerce Department data released on the same day showed that the import bill fell from a record-breaking $419.4 billion in March to $351 billion. In other words, the U.S. lost $68.4 billion in 1 month. On paper, the external deficit is shrinking, but the vein of raw materials entering the production line is suddenly thinning. While cutting imports so fast may shrink the deficit on paper, the sudden cut in the inputs flowing into the production chain is a shock that could force U.S. industry to contract in the long term. The strongest evidence comes from shipping data. Shipping consultancy reports that 20% of scheduled sailing capacity on the Asia-U.S. West Coast route was canceled. Blank sailings during April mean that container ships have either pulled out of the route altogether or had their schedules frozen. But this picture is not enough. Let's also look at the occupancy densities. While 9 out of 10 containers on each Trans-Pacific vessel were full in March, this figure dropped to 7 in April. An average loss of 3,320 foot equivalent units of cargo per day means around 100,000 20-foot equivalent units of empty metal boxes per month for the Los Angeles-Long Beach pair alone. Although the Port of Los Angeles' April statistics show a total of 654,000 TEUs of loaded plus empty containers, management said in a mid-May press conference that they expect import flows to drop by as much as 35% in the next 2 weeks and notified operators to adjust shifts. Los Angeles' 86 coastal cranes normally work 3 shifts 24 hours a day, but in late April the night shift was canceled. The number of movements per tower crane per day dropped from 1,200 to 790, a rough ratio of 34% operational intensity. Why are robots silent in Ohio? The supply chain is a pair of scissors. When the level drops at the oceanic end, the composition is not complete inland. In the Ohio-Indiana Rust Belt cluster, screws, chips, and engine parts stocked in March were shelved by the end of April. In automotive clusters, the assembly line's turnover rate, jobs per hour, fell from 62 to 49. If Trans-Pacific density does not recover in 3 months, there is talk of the line falling into the red by midsummer. According to Axios, the April report shows a $26 billion decline in pharmaceuticals, a $3.5 billion loss in consumer electronics, cell phones plus home electronics, an $8.3 billion decline in passenger cars, and a $23 billion drop in finished metals plus precious metals. A direct alarm for the production line. This contraction started in sectors with light shipments but high value since the value per kilogram per shipment is high. The loss in dollar terms, not density, is more significant. Why is cargo density important? According to port statistics, the nominal capacity of a post-Panamax vessel is 14,720 foot equivalent units. The same vessel that sailed with 13,600 boxes in March averaged 10,500 boxes in April, roughly 3,300 TEUs lost each voyage. Average net weight, 11 tons. That's 34,000 tons of empty capacity. On the freight revenue side, a drop in the TEU container volume indicates a spot gap. This gap affects both shippers' pockets and shelf prices as the cost per TEU increases by 115% as the density drops. Looking back over the past 2 years, it was already clear that the standoff between Washington and Beijing was gradually weakening trade flows. According to a March report by the Congressional Research Service, during 2023, the volume of U.S.-China goods closed at $575 billion, of which $147.8 billion were American exports and $427.2 billion imports. Compared to 2022, this represented a decline of 17% overall, 5.1% for exports and 20.4% for imports. At the close of 2024, the trend did not slow down. U.S. sales of goods to China fell to $143.2 billion, while imports rose to $438.7 billion, widening the deficit to $295.5 billion. Could this lead to a recession by summer? The picture became even harsher in the January-April period of 2025. 4-month exports remained at $40 billion, while imports reached $128 billion. When this momentum met with a dramatic fall in April, the total foreign trade balance contracted in a historic way. Reuters reported that the goods and services deficit fell 55.5% in a single month to $61.6 billion, the lowest point since the fall of 2023. While the goods deficit hit an 18-month low of $87.4 billion on paper, the shrinking of the deficit looks like a headline-worthy achievement. But the details suggest that it is a fragile comfort bought by the collapse of production momentum. In early 2025, the White House announced its decision to expand tariffs under the rubric of reciprocity, and soon entered into tense negotiations with Canadian, Mexican, and European partners. To avoid the expected tax hikes, companies built up inventories at an extraordinary pace in March. This front-loading was the main negative drag on first-quarter growth. By April, with shelves full and warehouses crammed with packages, the door was virtually closed to new arrivals, and $200 billion worth of import orders were wiped out in a single month. The decline was felt hardest in sectors that cater to both the consumer and intermediate goods markets. According to Reuters data, pharmaceuticals alone suffered a $26 billion cut, cell phones and home electronics contracted by $3.5 billion, and imports of passenger cars fell by $8.3 billion. A $23 billion decline in finished metal and precious metal inflows signaled a warning that production lines would have difficulty accessing raw materials. On the other hand, a record high of $289.4 billion was recorded on the export side in the same month. The majority of the output came from capital goods such as gold, processed metals, crude oil, and computers. In other words, companies brought forward their orders before being caught by the tariff schedule set by their counterparties. Just like the March inventory effect on imports, exports also experienced an April shipment shock. It is unclear which direction this will reverse during the second quarter. The subheadings of the data tell us that the shift in geographical distribution has also become more pronounced. Imports from Canada and China hit their post-2021 lows, while inflows from Vietnam and Taiwan hit historic highs. This is a striking sign that capital is reconfiguring the supply chain in favor of countries with the low tensions, with the U.S. Asian producers are taking advantage of loopholes in the Trump administration's list of country-based tariffs to accelerate the flow of orders, which in the short term may partially fill shelf space, but in the long term will inevitably raise the cost base.
Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.